PE is one of the most important metrics for evaluating a stock. I use it every single time I look at a stock, right? And I evaluate, certainly for the first time, understanding where it's at. It's one of the most important ways to determine, is a stock cheap or is it expensive or somewhere in the middle, right? So in case you don't know what PE stands for, it's the price to earnings ratio. Basically, PE is just a metric to evaluate, okay, it brings in this much profit and this is the share price, therefore the PE, this is the PE value, right? So any stock in the entire, anything that's public that makes a profit, we can determine its PE ratio, right? So we can see right here, Apple's PE ratio is 37.5. The S&P 500 average, which is the top 500 companies in the United States, their average PE is 27 right now. So this is a stock that is, valued above the S&P 500. We may say, okay, then this is an expensive stock. However, it's not the only metric you can use, right? Because we can see it's up 240% over the last 5 years. The S&P 500 is up 90% over the last 5 years. So this is significantly outperformed the S&P 500. It shouldn't be too surprising when it has a PE ratio higher, going off that logic, right? Because something that is deriving more value, it's earning more, it's grown more. That means, hey, if this is only valued, 30% more, and it's done 3 times as well, that's not super crazy either. However, this is still a PE ratio that is significantly higher, right? And PE ratio is sometimes misleading. It doesn't tell the full story. I like to look at PE and forward PE when I look at any stock. We can see here AMD's PE ratio is 123. Now we may say that is insane. Who would ever buy this? And yes, I'm not necessarily saying that's entirely discredited. However, when you look at the forward PE of the stock, it's all the way down at 27. There's weird things happening with AMD. They merged with a company. They're writing off a lot of debt. So the PE is a lot higher, and they had a couple quarters that were met in terms of margin. So the PE ratio isn't necessarily telling the full picture. Sometimes companies, get fined theoretically. Maybe they got free money from the government. That happens sometimes. It just does. So PE ratios are sometimes misleading, but they're also important. Also, if a company is unprofitable, the PE ratio is not there. You generally have to go off of revenue growth, debt ratios. Okay, is this becoming more profitable? Are they growing fast enough? You have to factor in a lot of different things. Doesn't necessarily mean you can't value it, but it's just going to be a bit more complicated. And then we can take a look at a stock like Caterpillar. Caterpillar's PE is 17.75. It is relatively cheap. It is significantly below the S&P 500 average, but also you have to factor in when companies are that far below PE, likely, and certainly if they've done well, right? This company has done well. It's outperformed the S&P 500 over the last 5 years. You can probably assume that at least for the next year, they're not projected to grow that much, and that is true. Usually, not always, but usually when a company has a PE value, it is for a reason, right? It's probably, if they've done well and it's fairly low, it's either an interesting industry or maybe they're not projected to grow a whole lot in the next year or two. And we can see that with industry in the terms of JP Morgan. JP Morgan has done relatively well. 5 years, it's gone up 86%. Since 2014, it's what? It was at 55-ish. It's at 240, so 5x. So it's outperformed the S&P 500 over the last decade. And the PE ratio is 13.5. You may say this is super cheap, but you also have to factor in the industry that it's in. So the financial institutions, right? Large financial institutions, obviously some banks, some more investment side of things, yada, yada. They generally have much lower PE ratios. And that's just because the regulations on these industries generally means they can only grow so much. Their ceiling's relatively capped. You have to factor in the PE ratio of the companies that are similar to it, right? And financial institutions usually rest somewhere in the PE ratio between 10 and 20, right? There's obviously some outliers, and this is generally the larger financial institutions. However, so you may go, oh, this is super cheap, and it is relative to the entire market, but relative to its peers, it's not actually that cheap. Now, there are many, many companies that don't necessarily have peers, right? The huge ones like the Mag 7, obviously you can kind of compare them between themselves, right? But oftentimes there are companies that are large enough that they don't, or they're niche enough that they don't really have any peers. For example, something like an ASML owns like 85% of its market share in the industry. There's nothing anywhere near it in its vicinity, right? Versus something like a car company, like a Ford, a Chevy, whatever it may be, General Motors. Those have peers and they can be compared to each other, and that makes it a bit easier. That's the basics of PE. There's obviously a lot more you can dive into when it comes to it. However, I think this covers the basics, and most of you hopefully understand a basic of PE. You know, oops, no, my mouse, that was my mouse coming on. I've recorded this whole thing, so I'm not going to restart it. I was rapping anyways. But yeah, hopefully you understand the basics of PE and how it works, how it's just a simple metric to, hey, a company earns this much and this is how much you're paying for it, right? And hopefully you understand a little bit of how to apply it and understand that generally PE, there's a reason behind it, not always. And sometimes you may say, okay, this is an exaggeration or this is an overestimation of what they can do. However, it's generally just a good metric to stamp on there and say, okay, this is where this company's at. But anyways, I hope you enjoyed this video. If you did, if you learned something, I'd appreciate if you left a like and subscribe. I've noticed when people have subscribed lately, YouTube's really been pushing the algorithm. It's really been pushing my videos out a lot. So I'd appreciate it if any of you did that. But anyways, I appreciate you for watching, and I'll catch you next time.